Now, sometimes he doesn't tell me the topic. Did he tell you the topic today? He's tricky like
No,
that.
I have no idea.
I think that makes it fun. I'm sure if he's going to throw a curveball, it'll be directed to me.
I'll help you out.
I appreciate that.
And I've been getting a lot of good feedback of folks hearing these particular conversations from the channel. And it just makes me more excited. I kind of teased you yesterday of a topic that I was going to bring up to the roundtable, and I'm not going to yet. But I need you there for it. You're somebody that I've been holding off for to be able to cover a certain topic.
Okay.
Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's roundtable, I'll be sitting down with my friends Joe and Miss Robin, where we're going to be talking about buy term and invest the difference as a philosophy in personal finance. We're going to talk about legacy. We're going to talk about infinite banking. We had a great time, and I hope that you enjoy. Anything you'd like to go over first, and we'll start the conversation. Do y'all have anything? I know y'all been catching up and getting to know each other a little bit better.
What Ms. Robin was saying, the buy term invest the difference is a really interesting thought. And if you think about it, when you're buying whole life, people compare the two strategies. Whole life, a participating whole life contract, you are part owner of the company, right? So you have the insurance and the investment in the company. Whereas term, you're like trying to separate the two to say, I only want limited coverage. And then I'm going to, instead of invest with that same company, be an owner of that company, I'm going to go somewhere else and try and be an owner of a different company and hope that different company can serve my interests better than this company. It's like at like the building block level, you're like, you have a choice of either combining the two transactions into one, or you're going to try and separate the two on a limited basis and go out into the wide world and find a different company you think is better. So you're like cherry picking the company, all the while there's no guarantee the company actually has your interests, like your interests aren't aligned. So participating mutual company, you're both the consumer and the owner. So all of your interests are perfectly aligned with that company. Whereas if you just buy stock, there's different versions of stock that give you different rights and voting rights and so on and so forth. But as the consumer, your voice is never heard. So over here, you're a consumer with the insurance company. And then over there, you're trying to be a minor owner of a company that your voice is not heard. So in a way, you're like surrendering your capital and you're surrendering your autonomy, your I don't know. It's an interesting to me. Like it's when you if I buy one share of Apple, okay, I'm technically an owner of Apple's company, but my ownership is like one billionth of a share. I have no voice. I have no control over anything. People
Anything, right?
willingly do that rather than hey, with life insurance because you're the owner, that's why you get control over the financing features. That's why you have control. You have a say in the financing terms. You have a say in some of these other, like where the insurance company is investing their money, first priority being policy owner. So as the owner, you're giving yourself the loan and you're setting the terms and relaxing the terms as you see fit as the owner. I feel like a lot of times we think of it like the consumer is calling the shots. It's still you, but it's you as the owner that's calling the shot, not the consumer. I don't know, maybe I'm spinning my wheels here, but
No, actually, I'd never thought of it, just the way you kind of laid it down. I think that's an excellent point because, in one factor, when you're aligned with the insurance company, everything's, so to speak, all in one bucket, you're in control. To the other factor, you're splitting your in essence, you're kind of splitting yourself, or you're marrying two different companies, and you're not in control at all. I never thought, honestly, that was a good point, Joe. I never thought about it from that perspective, but I definitely buy term and invest the difference. There are just so many things personally that I felt is just, I don't want to, just wrong with the, that strategy. And I can speak from just an older person, long term, buy term and invest the difference. One of the things I would always bring up, to people that were, believed in that, or were from these companies that, did the buy term and invest the difference, is like, how many people do you know that strategy actually worked? That 30 years down the road, they had their investment portfolio was now, by the time term runs out, 30 years down the road, you're 30 years older. And, the idea behind this strategy is that you would have built up this investment portfolio with the difference that you didn't put into a whole life policy. And now you should have this basically large nest egg that you can, in essence, self-insure, yourself, and take care of your retirement and take care of all your other needs from. And I'm like, how many people actually have done that? How many people do you know that actually have done that? If it was a strategy that, was as solid as you're saying it is, we should be able to look down the road and see a ton of people that, have so much money now because they did that strategy. But at least the people I spoke to, couldn't point to anybody, that they actually knew that strategy worked, So that's just one of my pet peeves with buy term and invest in different. You're selling me something but you can't prove that it actually works, and you can't guarantee me, because when I'm 30 years, I can't buy those years back. I can't buy those years back if it doesn't turn out that, I have this nest egg. Plus, you're putting your money, in, a stock, mutual funds that to your point, you can't control. So I have no idea if 30 years down the road, these stocks are going to really do, what they say they do. And I can't buy time back. That's the thing that, for me, I really see people have to grasp a hold. Time is so precious. It's so valuable. It's one of your, in my opinion, most valuable commodity, because you can't get that back. So you have to make decisions that are going to benefit you 30 years, when 20, 30, 40 years down the road, because hey guys, I'm that 30 years down the road. I was in my 20s. I'm not longer, and I can't buy. I wish I could go back to take the knowledge I got today and go back to being, in my 20s and 30s, but you can't, so, and there's no do-over when it comes to, the time and the decisions that you make financially, because the older you get, you don't have the time to recoup. So, to me, it's making wise decisions, in your younger years financially. And I'm just not convinced buy term and invest the difference is, my personal opinion, but,
No, that's like, wow, that's so good. So you can't buy time back. How precious time is. That really resonated with me. And like, there's no do-over, you said. You're really speaking to the true heart of opportunity cost. On the most precious asset we have is time.
yeah.
And you can apply that to money too. Like a wasted minute if you have a task to do and you choose to watch TV instead, well, you also chose not to do the task,
Mhm.
right? If you have a goal and you put your money towards buying a cheeseburger, well, you also chose not to achieve that goal. So like you have to wrestle with that opportunity. It's
Right.
hidden, right? Nobody likes to account for it, but every single choice you're either moving towards or away from something.
Mhm.
With time, with money, with health. It's like you're either moving towards the goal or away from it. Man, I love that. And I don't want to be like poke the bear too much with modern financial planners, but you mentioned buy term, invest the difference for 30 years. Most of those planners are retired now. So who are you going to go back to and say, how come my account is 300,000 and not
Mhm.
5 million like your spreadsheet said it would be?
Right.
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 And my bucket is 5 million and that's it. I've got to spend from that or hope that it generates enough income that I can live off of. Whereas the other one, the spendable dollars that it creates, like the permanent whole, specifically whole participating whole life insurance, the amount of income that can produce, it's like how you it's actually you've got to achieve a higher balance than just the death benefit,
Right.
right? To mimic the amount of money that you can spend in life with this and leave to the
Mhm.
next generation. That's all. I love that. That's good stuff.
Mhm. Mhm.
Now, hold on, Joe. When you were talking about watching television earlier, was that to include Eagles games?
No, 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 no. That is permissible.
Gotcha. That's
We
a
can take
quality
time out for
investment.
that, right?
That's a finite, that's a isolated incident. It happens once a week. It's perfectly fine. Indulge a
Okay.
little bit.
Just checking.
Now, come on. We were put on this earth also to enjoy it, right? So you can't just work, work,
Thank
work, work,
you.
work all the time, right?
Joe's happy somebody came to bat for him. I love it. Okay, well, y'all jumped in on this, and I'm just sitting here listening and soaking it in. Let me share a bit of my process, and I don't care if we exhaust this thing. Let's exhaust the thing. Let's take it. Here's how I'm processing the topic as we talk. So, buy, term, and invest the difference. Here's just how I think through this. Okay, buy. All right, so let's just associate a cost to term insurance. Let's just recognize, okay, that there is capital that we're committing to, 10 years, 20 years, 30 years, whatever amount of term. All right, so there is a cost there. And with term insurance, there will not be a return on that capital. And again, I'm not bashing that, okay? I'm okay with that. We're mitigating risk. I'm not saying that it's not valuable. It's super valuable. I'm just trying to recognize that it is there. Okay, so buy, and then we do come to the term. And how easy could it be for someone to say, even if they were going to do that, buy term and invest the difference, and they were really going to do it well? I mean, what's to keep somebody from just looking between 20 and 30 years and say, 20 will be enough, right? Maybe they're 20 years old, and maybe they say, for sure I'll have it done. By the time I'm 40, I'm going to have it done, right? They just lost a decade of coverage, perhaps, because of who knows what happens, right? And then maybe they're uninsured. So many things can change, right? Like a big 10, and that's just a little thing, 20 year, 30 year, but it's a big thing, actually. Okay, so just talking about the term portion is a big thing. All right, buy, there's a cost. Term, we're maybe even arbitrarily trying to pick some term, okay? If we're sitting across the table from, a modern financial planner or whatever. And, all right, well, like Miss Robin pointed out there, who even always does the and? Don't plenty of people just stop right there by buying the term and say, I'll work hard in my career. I'll pursue these certificates. I'll pursue higher education. I'll move up the ranks. I'll climb the ladder, whatever, right? And they actually stop short of doing something with money, right? Because there are two ways to earn a cash flow. People at work, money at work. So how many, what's the percentage? I don't know. But what's the percentage that actually just stops at the hole and invest the difference. Okay, so all right, so then let's go to the investment part. I think there's a lot of value in investing. I am never saying don't invest. I would say there are lots of ways to invest. You could be investing, we could be talking about investing in education, which means buying books, paying for seminars, paying your way into a certain group of people that are just going to elevate what it is that you do because they're in your circle, and so many different things, right? So you could be investing into yourself. I think that's the most prudent, it's the most profitable investment that you could make. But it could be something out there too that's not necessarily connected to your career or your field or your business. Okay, I'm not here to tell anybody what to do, but all these factors that Joe was bringing up about the minuscule control that we have, the minuscule ownership that we have in a lot of the conventional venues that people invest in. And I'll give you all an example. Just yesterday, I'm talking with a fella from South Carolina, first phone call. I had a buddy of mine say, hey, this guy needs some help. He's looking to do some out-of-the-box stuff. He's hit a roadblock. Give him a call, would you? Sure. This is a good buddy of mine, so I'm going to call who he wants me to. And I call this fella, and he's in a great career, so he does the 9-to-5 thing. Also, on the side, he has been doing his own business, working outside with equipment, buying and selling, upgrading his equipment, growing and scaling what he's doing, right? Just recently sold a couple of pieces of equipment, ready to buy the next bigger, better, upgraded version so he can take the business to the next level. Goes to thinking, well, hey, with my 9-to-5, I've got all this money in the 401k. I'll go get money there and just pull the trigger on this thing and it'll be hammered down. Roadblock, roadblock, roadblock. And I'm not giving investment advice here. I'm not trying to talk about those nuances right now. Joe, you feel free to jump in on any of that stuff, okay? I'm just giving you a framework and I'm going to kick it back to y'all. But he's told me about, no, there's this exception and there's that and there's roadblock, roadblock, roadblock. And he was furious. He was downright furious talking with me on the phone. And seemed like a real open-minded fellow, so I turned him towards, the information, the idea that he could become his own banker. I said, if, and here's how I put it to him, and y'all can give me feedback on all this stuff, how I'm thinking about buy term and invest the difference, this conversation that I had with this young man. Love to hear y'all's feedback on all of it. But what I told him was, look, talk to all the relevant professionals in your life. Right? Talk to the HR, talk to a lawyer, talk to whoever you want. Talk to those people. I said, but the next time you go get a piece of equipment, if you'd like to know how to get that piece of equipment in that business that you own, you control, you run, you manage, you've got a real pulse on things, and that's what he's telling me. I know that I can make more with this business. I've already seen it. I know that I can make more with this business than all this money that I've put into this 401k. And he'd put a considerable amount for being a young man. He'd put a considerable amount, six figures, into the 401k that he couldn't get to for this piece of equipment. He says, I know I can make more in my business, my side business. He still does the 9-to-5. In my side business, I can make more there than I could with the 401k. I might have forgot where I was going. But I asked him if you could get that piece of equipment and keep the money, would that be worth an hour of your time? Just to vet that concept, to expose yourself to that idea, that possibility. And he said yes. Said he was skeptical. And my response to that is beautiful. I hope you try and poke holes, okay, in this concept, because I'll take somebody who's skeptical any day of the week. Cynical, that's a different mindset. All right, cynical probably can't help you, right? Closed-minded, Robin, you said earlier about having ears and not hearing, eyes to see, not seeing, right? Can't help you if you're cynical, probably, right? But if you're skeptical and you look with open eyes and you just going to write down questions and ask things and question, like, are you what? No way, right? And you're going to follow that rabbit hole. Beautiful, perfect. But I'm just trying to put a real life person, right, to this thing that we're talking about with buy term and invest the difference. And then the last word in that whole phrase, okay, that's a bit about investing. We'll do the deep dive. Jesse, be quiet. I'm ready. But the difference, who determines what the difference is? I mean, who's actually going to go out there and shop? Hey, if I paid a ton of premium into whole life insurance, it would cost me this much. I mean, do people go out and calculate? No. The difference, that part of that phrase, that's such a nebulous word, right? Such a nebulous word. No meat and bones to it. Nobody's doing that part either. And then I'll end with this. I think there's a lot of value just in evaluating, hey, if that's your mantra, buy term and invest the difference, word by word. What are the pros? What are the cons? What are the ups? What are the downs to each aspect of that philosophy? Because it's a philosophy. It's an approach to life, right? And I just gave you all my framework there, and I'll end with this one. The access to capital. That's where this young man was. He had a lot of capital somewhere where he couldn't get to it. Taxes, penalties, roadblocks, etc. All right. Let's get y'all's feedback there.
So I would add just a little bit to the word and who does it, but in that framework, it's required. That's so you like when you think you have the options, like you are backing yourself into a corner that if you're going to mimic that, to attempt to mimic the participating whole life, you have to technically you have to buy term and you have to buy an increasing death benefit. Like you have to buy terms every year because this side, the death benefit's going up. So the cost on this side is going up technically. And you have to invest the difference. To your point, you got to every year you got to say how much was the difference between this, that, and the other. And now I got to put that in. You got to make a decision. There's like a discernment portion there where you have to now look at all the investment opportunities out there and say, where am I going to put this? And if you ask any modern financial planner, that's kind of like, that's taboo. They'll just say it has to be in a diversified portfolio. But each year you have to like decide because let's put it this way. If we're moving closer to, what did you say, the 20 or the 30-year term, that's your goal. It's got to equal at that point in time. Got to be better than the other side at that point in time. Well, then you have to decide the investment that's going to fit that new timeline. Right? For somebody that just says, hey, if you just make it a balanced portfolio or an aggressive portfolio. Well, when you make the decision you have 30 years, that might be okay. But as you get closer to the goal and you're getting closer, typically modern financial planning would say you have to get more conservative as you get closer because the goal, we have to have a certain amount at that point in time. Right. So maybe you start 100% stock, the riskiest stuff you can think of, Bitcoin, like whatever the riskiest stuff you're trying to gambling. But like by the time you're here, you've got to be almost in cash. So like it's very simplistic to say I'm going to get, pick your number, 6, 10, 12% each year, but it doesn't pan out. It doesn't actually apply, like it doesn't fit in modern financial planning. It disobeys the rules even of modern financial planning. Man, I love that. People don't, they're not even aware to think, to have the, as you put, skepticism of something like a 401k, a retirement plan. They don't even think to ask, hey, if I put my money in here, what happens if I need to get it out? How do I get it out? Under what circumstances can I get it out? And they're like, here's a list of 5 things that you're allowed to get the money out for. You can borrow against your policy, but you can only borrow, this much of the balance. If you had $1 million trillion in it, you could borrow $50,000. What?
That's it.
It's
That's
like
it.
the controls, like when they start to look at it, that's why people say when you put money in there, it's like you put it in jail until 59 and a half. There's a vesting. It's not really because it's your money. The police out there would be like, no, it's all
Say
yours.
it's your money.
They say it's your money, but it's like you got to wait a long time till 59 and a half, sometimes 55. But there's idiosyncrasies there and different rules, but a long time, decades before you can have open access, free, unfettered access to your money. It's like, I don't know. Most people, when they hear the full story and this is a great framework, Jesse. Even just using the words, man, just when you actually think through that, it's like, oh, wait a minute. That sounds a lot more complicated than I thought it was. It sounds like there's a lot more rules and requirements on me than I thought there was. There's a lot more lifting that I have to do, and I have to put at risk from my capital to make this happen. I'm like, man, I mean, Robin earlier said the keyword guarantees. It's like it's an inevitability that if you do this, this thing will happen. It's contractual. You've transferred the risk of a bad thing, like an untimely demise, passing away too early or unexpectedly, and the benefit side. Like you're pooling the risk and the benefit over here. Right? The insurance company has to deliver on the performance of it as well. You don't have to worry about it. You just know that thing's going to increase every day. And the other piece that's really interesting that's not brought up is this thing is growing at X, increasing contractually. This one's growing, hopefully variably. You can use this one again. Right? You have access to it to say, oh, maybe I want a piece of that portfolio. But hey, because like we said, it's got to get more conservative as we approach the goal according to modern theory and so on and so forth. Right? I don't need to be that conservative because my stuff's guaranteed. So I'm going to stay back here on this aggressive one. So my portfolio with this can be more aggressive the whole time. I don't have to worry about it. But because you put yourself in a little box, as we're getting there, you have to hit that target. You have to, right? If we're going to keep apples to apples, you have to get more conservative. It means you have to put more pressure on the dollars that you're putting in earlier. You have to take on lots of risk early so it levels out to the right rate of return to get you where you need to go in 30 years. How many people are thinking that? No. They just think, oh, buy the term, maybe put it in a 401k, maybe a Roth IRA, maybe in the S&P 500, and we're done. I've seen spreadsheets from professionals, decorated professionals that just do that. Like, see, look at this number. It's bigger than that number. Just do that one. Like, man, think through it.
That's one of the things that I talk about and recognize for myself. Like I said, I was one of those that when my husband and I were younger, he had a whole life policy, and when buy term and invested difference came, across our pathway, I was one of those people that told my husband, like, oh, let's count. Why are we paying all this money for this whole life? We can just buy the term and we can invest the difference. And we canceled our whole life policy with that position that we were going to invest the difference. But guess what? Life happens. We started out, but here's a key factor that isn't, taken in account is the discipline of, you have to be disciplined over those years, to your point, Joe, to get to that end goal that looked good on paper. I've got to be disciplined, over a large amount of years. And I'm making that decision early. And my husband and I's particular case, we were in our 20s when I made that decision. And I had every intention on investing that difference. There was no thought that I wasn't going to do that we weren't going to do that. But like I said, life happens along the way. 10 years from now looks a lot different, than it did in my mind 10 years ago, So that for me, those are some of the things that people, I think, don't take into account. You're trying to look, 20, 30, 40, 50 years down the road today, and, kind of thinking that that today is going to look, you know, like it will be 30, 40, 50 years down the road. So what happens when the hiccups come in along life's journey? What happens when life throws you a curveball? What now happens to that buy, term, and invest the difference plan? And that's what I feel like. You cannot plan into a future that, I mean, how do I say? You can't put all your eggs in a basket into a future that you have no idea what's going to happen down the road, which is one of the reasons, as I've gotten wiser over the years, that's one of the reasons that why, the concept of just the whole life policy itself is much better, way better than, in my opinion, than buy, term, and invest the difference. Because now I've got guarantees that guarantees me 20, 30, 40 years down the road, this is the pool of money that I'm going to be looking at, so versus, the buy, term, and invest the difference, I've got to try to somehow control those 20, 30, 40 years, so that I can get to that end point that 30 years ago they said it was going to look like. And I can't control. That's the thing I always say. What is shown on you, when you sit down with your financial advisor and they lay out these beautiful spreadsheets and they say, if you do X, Y, and Z, then you will be here in 20, 30 years from now. My problem is, you've got to guarantee me the sun, the moon, and the stars are going to line up and I'm going to be able to control that for the next 30 years. And I can't. That's what I think people just have to think through. You cannot control a large number of years what life has in store for you. So in my mind, that's what you're doing when you're buying term and you're investing the difference. And you've got to have that discipline factor for that amount of years, to be able to hopefully end up there. And then here's my other question. What happens if it doesn't work out? What happens? Because now you're 30, 40 years down the road. Now term has expired. You now have no insurance. And your nest egg didn't quite get to the, that pretty picture point. Now what do you do? Now, 30 years later, you got some illness or something. Now you're uninsurable, possibly. Now what do you do? Now what does your family do? You're putting a lot of hope in something that you can't control. Why position yourself that way?
Robin,
Yep.
wow. That's oh, sorry, go ahead, Justin.
Well, what I wanted to say there is, and Miss Robin, you practice what you preach. So just in case somebody's hearing you for the first time, because it's not your first time on the channel, you and I have done an interview, a couple of interviews. This isn't your first roundtable, but you practice what you preach. You've created a multi-generational private family banking system with whole life insurance. And furthermore, you, like other folks, have experienced losses in family, even recently. So I understand your come from when you're talking about the value of guarantees and you're talking about the value of just accounting for what is certainly going to happen, which is that 100% of Americans end up dying. That's just the reality of it. And when you check that box at least, it's got a lot of value. So I would like you to answer your own question. I've got a couple of things I want to, you guys make it sound like you're presupposing that Americans aren't being diligent and disciplined and proactive every year and sitting down with their professional and titrating things in, etc. To, like, if somebody is in that route of buying term and investing the difference, and I'm being facetious here, sarcasm's a language in my household, y'all make it sound like folks aren't actively, proactively taking care of these things and changing and updating, and because they're not. There's literally this phrase, right? Set it and forget it. Take 15% of your income, save that into your retirement, set it and forget it. All this stuff sounds familiar to y'all, to everybody that's going to be listening. But do that, Miss Robin. Answer your own question. Because, listen, some folks were like this young man that I was talking to yesterday. He's closer to the beginning of that process than he is at the end. But there are going to be, so earlier this week, I was talking with a fellow who's already retired, right? And he'd done some of the traditional things, okay? He's actually old enough and in an industry where he had a pension. Now, check this out, y'all. He had a pension. He's got guaranteed income, right? And his son pursued the same career. Sometimes that makes parents feel good or bad, right? But his son pursued the same career, and that career's changed, like many other places, obviously, where he's not going to have, a pension. He's not going to have guaranteed income from that industry or from that field, right? Or that organization. It is all this traditional stuff that we're talking about right now. So for folks right there that are on the back end of, maybe they did go the buy term and invest the difference, Miss Robin, I'd like you to speak to those folks who are maybe looking at retirement, facing that transition from, one career to another one, right? Maybe they don't want to make the same mistakes with their encore career, and, because plenty of people do that. Military folks. You could do 20 years in the service, right, and be retired, quote unquote, at 40, right, and of course be just walking in on a business or investing or an encore career or whatever. So talk to folks, if you would, who maybe that is the case, that they did the whole buy term and invest the difference, and things didn't turn out the way that they want, but now they've been exposed to infinite banking. If you're sitting across the table with somebody in that situation, what are some things that you could say from your own, the things that you've personally implemented in your life, but also speak to them as a professional like you are?
So those that have kind of gone through their younger years and moving toward the retirement, such as myself, at this time, things may not have worked out financially with the buy term and invest the difference, strategy. So one of the things that I talk about is looking at getting the whole life insurance even now. And that's the beauty, is that as long as you're insurable, you can get it on yourself. Okay, the whole life policy, and start now. And the thing that I always say is, when we're older and down the road, time is not, we don't have the same amount of time as we did when we were in our 20s and our 30s. So it may take a little more dollars to do the same thing that I could have done when I was in my 20s and 30s, but I tell people, to start now and getting that whole life policy, getting it in place, and letting that tool begin to work and build. If you aren't insurable, the beauty about it is that you don't, that's okay. Now we take the people that you have insurable interests on, and they become the insured person, but you become the owner of the banking system or the banking function. The beauty is that you are still, it doesn't matter, you're still in the position that you can begin to build this warehouse basically either on yourself or someone that a loved one that you can insure. And to me, I just love the fact that I have the freedom and the control. And by putting this tool in place. I'm not sure if I'm answering that question, Jesse, if that's what you wanted. But to me, what I have seen some people realize is that when they get in the older years and when they did the buy term and invested difference, now that term is expired. They didn't die during that term, because that's the only way it pays out, is that you have to die during the term. And that's what I don't think some people realize. And so, if you get down to that point and you didn't die and that term is expired, and now you're 30 years old and you're 30 years older, and now you try to go and buy that same amount of term again. I've seen people try to do that. They'll go and try to buy that same amount of term again, and they're shocked, sticker shock, by how much more it costs them to get that same amount of term. And what happens is most people, I've had people tell me, I can't afford that. I can't afford the price of the term now that I'm, 30 or 40 years older. And so they end up, not having anything at all. So I am one that still believes, no matter the ability to buy the whole life policy and build your, I call it your warehouse or your storehouse of money, you can do that. Even if you can't do it on yourself, you can always do it on, a loved one, somebody that you have an insurable interest in.
Right. I would run through that. I would just reiterate all the things that you said, which is I also believe that the place for someone to start, no matter where they're at in life, is on themselves. If you can get a policy on yourself, get a policy on yourself for all the right reasons. Number one, if you're the head of the household or you're the older generation, you want to benefit the next generation. The best way to do that, check the box quickly, is we'll get that guaranteed legacy on yourself, because then they're going to get that check, right? Income tax free. And then the other reason is to lead by example. For people that are catching on to just the idea of whole life insurance, just the idea of a guaranteed windfall to the next generation. I'm not even talking about infinite banking yet, but if that's important to you, lead by example. Create that culture in your family that, hey, we take care of those that are coming behind us. We're ahead in the path. We're going to knock the briars and stuff out of the way, because that's the position that we're in, is we're going first, okay? And then when you do throw in the banking function, it just opens up all kinds of things that you were talking about. Like, let's say it's that person again, Miss Robin, that was saying, well, Jesse, I don't have the cash flow because of my age or whatever. I don't have the cash flow. And it might not make sense for someone's cash flow to be able to get a policy on themselves. And maybe their starting point is to get a policy on a child, a grandchild, or whatever, because that makes cash flow sense, right? And that's why a one-on-one conversation is so important with somebody who's personally implemented this concept, right? So they can help you navigate that. But my question is, why is it then that someone could say at any point in life, I don't have the money for X? All right. So if we go right to becoming your own banker, doesn't Nelson say that the average American is bleeding out 34.5 cents of every dollar that, well, no wonder we don't have the cash flow for the things that we, could be benefiting ourselves and we're bleeding out interest dollars left and right. So yeah, even if you do start a smaller policy on a grandchild, but that allows you to start keeping a percentage of that cash flow that was going out of the family, doesn't that position you better to be able to keep more money, to have more cash flow, to do something significant with privatizing your banking? You had a thought there. I saw it on your face, Miss Robin. Tell me.
We're just thinking, yes, not only the interest that we pay out, but the other area that I look at is the taxes that we pay out as well. It's like if you if you could just take those two things, those areas, the interest you pay out and the taxes you pay out, and you can minimize how much interest flows away from you and how much taxes you pay out, then you've got more dollars to put towards, building your own system, your own pool of money. But that's what I was just thinking. It's like, wow, we really don't realize how much interest we pay out. And then we're taxed to death. You look at it and we're taxed all over the place. You got cell phone tax, you got city tax, you got this tax and that tax and grocery tax and all this other taxes, and a lot of money. I realize that, kind of like what Nelson's saying, is that 90% of that dollar, you look at a dollar, 90% of that dollar is going away from you. And then you're trying to live and function and save and grow your life on 10%. And that's being generous. It's really less than that. How does that work? How do you ever get to financial freedom that way if you're letting 90% of your dollar walk away from you, basically, or you're giving it away? I always say you're giving it away. How do you build your financial future, and you're trying to work hard? I just look at so many of us, I just say the average American, person is they're going to work, they're doing what they can to bring a dollar into their home. And the sad part is that we work so hard to get the dollar, but we don't work hard to keep that dollar, because we won't educate ourselves. We won't expand our mindset. We won't learn the most important thing to literally every household in this country is the dollar, because you need it for everything in your life, everything. You cannot, this society doesn't move without dollars moving from your hand to the next person and back into your hands. But we don't take the time to learn how to keep as much of that dollar under our control. That's the key, keeping the dollar under your control. Because if you will do that, then you can grow dollars under your control. You can't grow any dollars if it's under somebody else's control.
I know that no, that's good, Miss Robin. You're making me think of a verse, so I'll say it because I know you'd appreciate that. And Joe's the guy who said this here recently. He read it for us. And it's the verse in Proverbs where it talks about being diligent to know the state of your flocks, right? Where you've used the word discipline and that type of mentality often in this conversation. It's so good, Joe. I'll tell you, brother. I've got two things that I want to ask you about, but I know you've developed your own thoughts so far. So pitch them to us.
I was smart enough this time. I've got a little pad of paper I'll write down. So go on, have at it.
What? Well, okay. Well, if you don't have a follow-up on that, Miss Robin, I'll try and remember these two questions and go ahead and ask them now. And I'd love to hear both of your thoughts. So strategically, there's a way to incorporate infinite banking, okay, owning properly structured whole life policies, all right, because of their guarantees, because of their access to capital and all these advantages. There is a way for people who have, accumulated, and that's a lot of people, right? They've put money in an IRA. They've put money in a 401k. They might have a state retirement. They might have a CD. They might have some savings. They might have some money in different apps on their phone, right? Where just some's here, some's there, and they've got it in several places. Well, when they're exposed to infinite banking, there's a way for them to be able to incorporate Joe, those ups and downs of the market that you were talking about earlier. So let's say somebody's close to or maybe right at or in retirement years, okay, passive income years, supplemental income years, and the market has taken a hit. Well, if they also have capital build up in these policies, can't they decide where it's most advantageous to be siphoning, capital from or cash flowing capital from this collection of assets that they have? So you get what I'm saying. Talk through that a little bit for folks who might be in that situation.
It's your turn, Joe.
So that I guess modern financial planning calls it a volatility buffer, is what you're talking about, or you'll hear the slogan "down markets matter" from some of the bigger companies out there. Whereas when your portfolio drops, if you take money from the portfolio, right, you're liquidating more shares of the portfolio to create the same amount of dollars that it otherwise would have when it was up here. So because of that, you're hindering the future growth in a huge, huge way. So they say if you can, you need to have something to access when your portfolio, ironically they admit, when the portfolio drops, you need to be able to access money to allow this to recover some before you start pulling money from that again. It's a really good strategy. In my opinion, it puts the emphasis on the portfolio where it should not be on the portfolio. In my opinion, it's like life support for the portfolio, which is flawed to begin with. It's allowing it an extra X number of months or X number of years to breathe, quote unquote, to hopefully recover and continue on that original trajectory where it's just, up and to the right. And yeah, if you have that is one use. It's a common use for modern financial planning. I think it misses a couple of points that I've got some notes here. I'm going to try and tie it back to what you guys were just talking about. That let's call it a 401k to start with, because that's pretty like a retirement plan. That's pretty broad. A lot of people have that. The retirement plan is not designed to be passed generationally. Okay. It can be passed one generation or a finite number of years. Right now, that's 10 years. Right? You used to be able to place it in the next generation, and they could liquidate it over the course of their life. But right now, they trim that up to 10 years because the IRS wants their tax money. Right? So it's not designed to go one generation, two generation, definitely not three generations. When you pass this retirement plan to someone else, there's a couple exceptions, but most of the time they can't just pull it into their existing growing personal retirement plan. So if they have their own retirement plan, they can't just say, all right, we'll take that and we'll throw it in here, make the scale of my capital bigger so we can keep growing, right? It's not designed for that. You got to keep it separate, and it's got to abide by this rule. If you inherit somebody else's 401k, you got to take it out in a certain period of time. You can't commingle it with your own retirement savings and let it go into your retirement to take it out. On the other hand, you're talking about a volatility buffer using participating whole life insurance. That asset is designed to be passed to the next generation. And it's also open-ended, meaning it can receive premium from any source. So if you took 401k distribution, you can pay a premium. If you took Social Security, was just deposit, you could pay a premium. If you took a Roth distribution, you could pay a premium. An annuity, you could pay a premium. Stock portfolio, pay a premium. Earned from your W-2, you could pay a premium. We can keep going, but it can do that conversion from whatever you put into premium from any source, including death benefit. So it's designed, it has this cascading, like growing, you could pass from generation to generation, if done correctly, indefinitely. I'm like, that's a beautiful thing. like, so the question isn't, hey, should we use it for a volatility buffer to salvage this flawed thing that can't be passed? It's more like, is our preference on asset incorrect? Why are we favoring this instead of this? What is our actual goal here? Can this support that instead? Instead of saying when it's down, it's a volatility buffer, which may be part of the equation, but maybe when it's up really big, it's paying premium. Like we're trimming off the huge gains, the outsized gains. Maybe that pays premium instead to bolster the asset that is designed to be passed. Sorry if I'm going a different direction than you were anticipating.
No, I love how you're verbalizing these iterations of, well, somebody might have these things in their life, these investments, these assets, and maybe they're in the mental space of only acknowledging whole life insurance where they have access to capital as a volatility buffer. Could it be that? Yes, but I love how you said, isn't that just like putting life support on the investment that is the volatile aspect of the equation? I love that. I'd like to be able to use that in the future, life support. Because you got life support over here on that stuff, whereas in the other world, the advantageous, the friendly environment, right, Joe? The friendly environment, you've got cascading. Right? Well, give me more cascading, please. That's beautiful.
And it's ironic because a part of this equation, like you mentioned, set it or forget it. Set it and forget it. Sorry, set it and forget it. How many things in life can you actually do that with? Like go out to your garden, do all the research and dig it up and plan it correctly and have the things separated the way you need to, protect it from the outside world and the bugs and all that. Just set it and then walk away in 5 years. Tell me what happens. It ain't gonna look like you set it up. It's like there is no set it and forget it. Right? You can delegate. Like in whole life, what you're doing is you're placing your capital into a mutually beneficial, friendly environment where there are people looking after it and monitoring it and putting it to work. It must be putting it to work every day. So for you, it feels like you set it and forget it. But the company is very diligent in what they're doing with your money. That's what popped in my head when you said that. It's like there's nothing, like it's like there's a free lunch. There's no such thing as a free lunch. And that kind of goes back to opportunity cost. There's always a cost to what you're doing, whether you acknowledge it or not, or whether you recognize it or see it or not. That's a different story. But there's always a cost. You're always either one or the other. Mm-hmm. Moving this direction means you're moving away from that, right? That you can't escape it. I don't know. I was going to backtrack a little bit. I wanted to touch on, just finish up what I was saying, like the incomplete, simplified comparison of term versus buy term invest the difference compared to a participating whole life. It's like the other, like, so we didn't mention tax yet. So think through this, like, or 30 years or Ms. Robin said 40 or 50 years. Okay. Yeah. Did the tax situation, did it change at all? Or even if we apply today's rules and just pretend it's going to be the same, as your portfolio is creating income and capital gains, now you got to pay taxes. So that means the growth on it, you're putting more you got to be more aggressive. So you aggressive, taking on more quote unquote risk to make sure we get enough growth to pay the taxes, to pay the fees, so it still hits the target. It's like that's just one, like, okay, how about inflation? The dollar that you first started paying is locked in on the permanent life insurance side. Okay, their job is to make sure the value of the benefit maintains, like inflation adjusts, cost of living adjusts as it goes through life. That's their job. You don't have to worry about it. Well, you're over here, right? You've got the dollars you're paying in the first year are worth one purchasing power. Mm-hmm. The fifth year, they're a lesser purchasing power. So, oh no, now we got to put more in to make sure the purchasing power that we transfer out into the future is the same. Well, let's think about this. That means you have to earn more, right? Your salary's going up. Well, if the tax rates haven't changed, it means you're paying more taxes. So $150,000 in year one compared to like, I don't know, 450 in an inflation world, it's the same, right? Because this had to grow to keep up with inflation. But in the tax adjusted world, it ends up being less because 450 is taxed more aggressively than 150. So like it's riddled with problems. Maybe I'm overcomplicating, but it's just riddled with problems. And it's an easy slogan to it's like Jesse, I think one of your episodes, you were like, you hummed the McDonald's ba-dum-ba-bum-ba, right? It's a sales slogan that no one thought through. It's like, yeah, that makes sense. Buy term, invest difference. Of course I'll be better. Of course we'll all be better off if we just do that. It's like no one thought through it. No one actually put some real analytical, open-minded, healthy, skeptical thought through this. Man, there were so many good things you guys said. How about why would someone do this, as they're approaching retirement, right? Or for that matter, when they're approaching 50 or when they're approaching 40 or 30. Why would you do it as you age? And I think Nelson gave us a really great, it's actually like it's a blurb in the book. People skim right past. Cash must flow. Whether it's you're 18 and your first job or something, or whether you're approaching retirement and then you're going to liquidate assets to pay things. Spending is the same. You're going to spend your whole life. What you spend it on changes, sure. But you're going to spend your whole life. The cash must flow. If you think you'll be spending money, what better way to spend it? Like, this is the best platform to spend from. So yes, if you started your system when you were 18, would it be more robust than when you started when you're 64 and a half about to retire? Yes, it will. But will you still turn pennies into dollars at 64 and a half? Yes.
Yes.
Will they be $10 bills or $100 bills? No. But pennies become dollars. It's like whether it's $1 becomes $2, right? Or 1 penny becomes $1. It's like, okay, that doesn't wow me. Why should I do this? Is what people are thinking. But like it's the guaranteed multiplication of your net worth on a contractual basis. Given enough time, like you're just starting the curve later in life. Given enough time, it still does the same trajectory. In the curve early on is still better than the alternative. So it's like, yes, people like do this mental accounting where they're like, well, it's not going to be $10 million, so why should I do this? It's like, man, but you could take your 100,000 and maybe make it 300. And that might be game changing for the next person that receives that. Don't diminish what you can do. The alternative is you're just going to pass 100,000, right? You could pass 300. If you started when you were 18, it might be $1 million. And people get mad because they compare the 1 million to the 300,000. They're like, well, it's not that big a difference now. 100 to 3. It's like, that's a 3x on a guaranteed tax-free basis. When you adjust for that, it's more than 3x.
I think if somebody used this filter on that clear-cut example, Joe, why bother? Just 300,000 from 100,000. Look at it instead of it being your result, because your results are going to be what they're going to be, right? Based on time and choices and all these different things. But if you are thinking long range, which is what I would encourage people to do, that's a lot of seed money right? So don't look at it just as your harvest. Look at how much seed you're giving to somebody else.
Man, that's beautiful. That goes the legacy piece. Ah, if well, and just to put a nail in that, like long term is not 30 years. Long term is not from now until you retire, or 35 or 37 and a half years. Like long term is 5, 6, 7 generations into the 300 years into the future. So when you put that in perspective and you're like, I'm mad, I have partial liquidity for 3, 4, 5 years. How silly do you sound? 3 years out of 300, you have partial liquidity, and you're like, oh, darn it, not worth doing. Guess I'll go put money in a 401k and that I can't touch for 50 years. It's like, think. What's going to set you up and all future generations up better than anything? You have to come to terms with that, but if you're being objective, including like skeptical, come in skeptical, ask questions, but be open-minded that you might be wrong. If you go that route, I know where the answer goes. At least the current the current menu of options, I know where the right answer is. That's why I'm like, I take the same approach, Jesse. Like I'm not here to battle you. Just ask. I'll just keep corralling you to say, keep asking questions. Because I know if you keep asking questions, it goes one direction. I don't have to sell you. I don't have to convince you. I don't have to battle you or compete with you. But if you're open-minded and just keep asking questions, it leads to one answer, which happens to be the best answer. I don't know.
I think that's one of the shortcomings of our society, Joe, that you just mentioned. It's just thinking generationally. Most people they think about themselves. And, I say we're a selfish society because it's all about me and my trucks, so to speak. But we don't think generationally. And I think about the scripture in Proverbs where it says, a good man leaves an inheritance to his children's children. Right there's 2 generations there, 3 generations, 2, 3. And I think about that in that because I've had people say, "Oh, I'm not leaving anything for my kids. They got to get theirs." Like, I worked hard. They need to work hard. And I just think how that's just I'm sorry, that's just a stupid, thought process, that you even if you look at it, you struggle to get maybe where you're at, and your thought process is you want your children to basically repeat those same struggles. That doesn't for me, that doesn't make sense. So I feel like that's another shortcoming of our society as a whole. I'm not saying it's everybody, but it's a shortcoming of our society that we don't think generationally. And to your point, why are you thinking, okay, to 5, 10 years when you need to be thinking 300 years? You need to think about your children and your grandchildren and your great grandchildren. So that, and that's the picture that I try to paint is, building, if you will, your banking systems and building them so that it's taking care of several generations. And think about your entire family name being able to control all those dollars and keep control of those dollars. So it's just something that, it just struck me because we don't think generationally, unfortunately.
Wow, Rob, man, that's so. So in the book, in Becoming Your Own Banker, in Nelson Nash's book, there's a chapter on the distribution of age classes, and he goes through this concept. I would encourage anyone to read that within the context, like what he's saying, try and visualize a family tree. Like he's talking about planting trees as a forester, but like visualize like the trees are policies on different generations. So when he says, "Oh, we're gonna, for the first 10 years, we're gonna do this many acres or something like that," that's generation one, and it's generation two, and it's generation three. Read it with that understanding that this is designed to create a to Jesse quoting me, the cascading like generational wealth for a family. And then that raises even more questions to your point, Ms. Robin, where we're so selfish in I think that might be something he could have put in the book, or maybe I missed it in the book, where that is a huge human problem. The self-absorption, the narcissistic, egotistical, the natural state of a person in this country is very much me, myself, what can I benefit? If you can get out of that and say, my family, the family legacy, the lineage, if you think in terms of lineage, man, you'll gravitate to this concept much, much faster. And things like, hey, there's going to be a point where the parents will consider stop paying premium, or might have to make a choice to stop paying premium, where the kids can say, I'll pay it for you. Because, like, if you think about what happened, they bought a policy way back when, the premium is locked in. So the inflation dollars from back then are transferred to now. So kids now with bigger salaries can pay an old premium, but the growth in the policy is way outsized compared to the premium, all the while knowing that that's just going back into the system. That's seed, to Jesse's point, to cascade to the next generation. Why wouldn't you do that? And similarly, for parents, there might come to a point where they're like, I have to decide, should I buy another policy on the next generation or the generation below that one? Again, creating this place that can receive the cascade, right? And keep the cascading, like this place to receive that benefit as a premium payment, so we can keep going. Because parents are already going to have a big income in theory, so they're able to now lock in the children's premium at these inflation dollars for the rest of their life, making it significantly easier for the kid to pay those premiums. And you can kind of jumpstart the policy for the kid for 5, 10, 15, 20 years, 25 years, as long as you want to, and then pass the policy intact to the next generation so they can keep feeding the beast. It's like, man, it's like there's so many planning opportunities to create generational wealth that it's.
These are such good nuggets. These are such good insights, and I love how y'all are verbalizing stuff. Ms. Robin, I know that you provoked someone by simply saying 300 years. Listen, if you need to do something, you do something, okay? I can talk for a minute if that's what that hand motion's about.
Okay, well then I will dip out. And I enjoyed it. Joe, you are awesome. Jesse, this was great. Perfect. I love it. Thank you guys for letting me just sit in and chime in with you.
I appreciate you, Ms. Robin. I'll talk to you soon.
Okay, take
All right.
care. Bye-bye.
Bye-bye.
Yeah, what I was saying, Joe, is that I know that she provoked people just by saying the words 300 years a second ago. I know she did, because I can remember where I was, what year it was, what state I was in, what the room looked like that I was in, when I heard someone for the first time encourage me to think 8 generations ahead. That's the first time I'd ever heard anybody even say that. So just by Miss Robin saying something about 300 years, I know that she provoked thought in somebody and inspired somebody, which is just really neat. Legacy always ties in for me. Becoming your own banker, reacquiring the banking function in your own life, it's just a synergistic part of looking long range and thinking legacy. I want to also go back to some of the things that you said earlier, and I've on my channel, and I would encourage people that if they haven't seen my video on these, because I like doing topical videos. I've done, a video on taxes as it concerns infinite banking, and I'm not a tax expert. Don't sue me. I'm not a tax expert. I'm not giving advice, but I address the topic of taxes. I address the topic of inflation. You mentioned one. So I'm saying taxes, inflation, interest. These are all things that we've mentioned in our discussion today. Another big one that you mentioned, but we haven't elaborated on, is fees. Because again, we started with this conversation of buy term, invest the difference. If somebody is proactively contributing to a 401k for the next 20, 30, 40 years, even a fee of 1.5%, right? And it could be 0.5, it could be 2%, but I'm saying a number that I've seen before, that you've seen before, that anybody could see on their stuff, right? It could be a 1% or 1%. So I've also done this on my channel, I believe. So I'm encouraging people to search and look for this stuff. But I do this penny doubled every day for 30 days scenario, Joe, right? And people are wowed by that. I was wowed by that the first time I saw that. Oh, wow, a penny that doubles every day for the next 30 days gets to over $5 million. Amazing. But then I took that same exercise and I applied a 15% tax, right? And it's not 5 million anymore. It's not the 5.3 million anymore, right? Because of the taxes. And you'd be blown away if you've never done that, what that number is. Same thing. Withdrawals. You could take that same penny that doubles every day. After 30 days, it gets to 5.3 million. But again, if you just make 2 withdrawals of, say, $100, you're nowhere near 5 point. It's not even half, not a quarter. It's ridiculously low, right? But then fees. Fees are just one of those things that I feel like go under the radar, right? That 1.5. But again, if you run that same penny that doubles every day, it's nowhere close. And that's where, the whole rate versus volume thing comes into play as it relates to compounding over a long time. So I don't know, anything, you were the one that mentioned fees earlier, but you let it lie. Anything that you'd say there to that aspect of buy term and invest the difference and how fees play into that?
And so the industry's not going to like this one. I would say for your clients, consider anything that comes out of your account or reduces your return, anything that did not have to do with your choice, a fee. So that means, like, I'm going to throw a little bit of jargon, I apologize, but there is a stated advisory, AUM, assets under managed, advisory fee, typically. There is something called an internal expense ratio or a net expense ratio. There are administrative, like flat fees, like $10 per account per year. I don't care what they call it. And they'll try and use jargon and throw, that's a different category. I don't care. Anything that comes out of yours or inhibits the return, like that the expense ratio I mentioned is on a lot of mutual funds and ETFs, and that you don't even see that. Like, you'd have to look up the individual funds you have and say, hey, what's my net expense ratio? And it might say 0.5%, something like that. So that means every year, if you earned 10, they take 0.5. So you only see 9.5 growth. Well, that's a fee. You didn't pay it out of your balance, but you paid it out of the growth. I consider it all. And 1.5, that's pretty common. 2, when you add all the fees together, yeah, it's pretty common. And Jesse's right. You want to go online, search up a future value, calculator, and say, if I put $100 or $1,000 in every year for X number of years, right? Here's my return, 6, 7, doesn't matter. Pick your return, and then reduce the return by 2%. and see what the balance is. You're going to be shocked at how much smaller the balance is. And that goes back to opportunity cost.
Could I jump in there real quick, Joe? I hate to interrupt you, but so take that same number that I've thrown out there, the penny that doubles every day for 30 days. A lot of people, because what you just said right there, a lot of people, when they hear that, they'll think, well, 2% of 5.3 million, that's nothing. I think, at the surface level, they're thinking, what do I care about 2%? If I've got 5.3 million, I'm happy to give them 2% of my 5.3 million. But that's not how it works, because every year it's 2% off of that. So that inhibiting that you talked about, and you gave this hand motion of patting it down, knocking it down, beating it down. That's what it's not 2% of 5.3 million. It's it's that 2% or the 1.5%, whatever it is, over the whole course of time, whether your account is doing this, whether your account is doing that, but it's happening over that time. It's not like you get the 5.3 million and then you just give 2% away. No. Right? So, sorry.
No, and it's a great point. The 2% is like taking a partial withdrawal every single year. To your point, when you said if you just take $100, you're way off the mark. If you take $100 twice, you're really far off the mark. Well, you're taking a small, because of the fees, you're being forced to take a small withdrawal every single year. And here's the advisor would say, you're going to look at the difference between 5 million and let's say it drops to 1 million. I'm just pulling numbers out of the air. So there's a $4 million gap. The advisor is going to say, look at my bank account. I don't have $4 million from each of my clients. I don't know what you're talking about. I didn't steal $4 million from you. And that's true. He probably made a fraction of that. Like if but the growth that by taking the withdrawal, you sacrifice the opportunity cost is the growth off of that. That's gone. And that's because of the fee. So that's why I say, I don't care what the advisor says. I didn't make that much. I didn't get paid this year, right? I didn't get, I don't know what you're talking about. It's like the fees coming out of your account are not going to you. So consider them a fee for the family. They're going to someone else. They're a fee. Call it financing fees. Just call it fees. It's a fee if it's not in your possession. And you need to measure all of the fee, including the repercussions of that fee, to say, is that worth it? Sometimes, yeah. And sometimes people are happy to pay that. That's fine. Maybe you spent your whole life accumulating all of this money, and then you're going to start having a manager, which is 1%. But you didn't pay it the whole time, so maybe you have the full $5 million. Maybe. Stress maybe, but you can choose to do whatever makes sense in your world. That's fine. But all people like me, people like Jesse care about is you need to be aware of the seen and the unseen costs of what's going on. Both halves of the equation, right? The full total picture. So if you can, we talked about legacy. If you can think in terms of lineage and legacy, this concept will make a lot of sense to you. If you can open your eyes to say, I want to see both halves of every single transaction. Remember I said, if you're not moving towards, you're moving away from your goals. You got to add up all of the plus and minuses, all of them, to say, does this make sense or not? And, in this, just both halves of the conversation, both halves of the equation, you've got to be able to say, for example, this IBC is based off of, I'm going to borrow money from a third party, pay back the principal and the interest, and not collect the dividend. Okay, I'm going to borrow from Jesse, pay him the principal and the interest. It's like, if this is his business, he's probably going to earn a dividend from the business operations. Right? If I'm going to borrow from my savings, most of us don't even put it back, the principal. We definitely don't put the interest back, and we don't even think about a dividend. Those are unseen costs of using our capital. That's the full picture. If you're going to compare borrowing from a bank treat yourself like it was a bank and say, well, here's what I would have owed myself. It's like, that's the opportunity cost. It's the same thing as the fee on your assets under management with an investment relationship, a portfolio manager. The fee is the opportunity cost. It creates an opportunity cost. So if you borrow, the fee in this sense would be the lost interest, the lost dividends, like the lost growth on that permanently. So if you borrow from your savings account, which guess what? You're all going to put money back into your savings. That's why there's always a payment. Whether it's to someone else or back to your savings, there's always a payment. You're not saving up and making one purchase in your entire life. You're not. You're spending money happens all day, every day. You're going to do it your entire life. It's this revolving door. Do you want to control that environment and keep it closed so it stays in-house in an environment that's perfectly contractually designed to be passed to the next generation so they can do the same thing and just keep growing this reservoir for the family? Or do you want to try doing this whole hodgepodge? Most people don't know that's an option. And that's another thing. Most people aren't open-minded enough to know that that's an option. You can benefit from all that. To your point, what did you ask your buddy? It was like, hey, the next time you want to get that equipment, if I can show you how to do it and you keep all the money, you think that'd be worth an hour of your time? And we can kick the tires on that all day long. They don't know it's an option. Most people are acting with the information and their experience up until that point and the professionals around them. That insight is how they're making decisions. No one's saying, I'm going to make the worst decision possible with my money. No one seeks to do that, or the average person is not seeking to do that. But when you're in contact with new information, that requires you to reassess your experience, the information, the insight, the professionals in your life. You need to bounce that off of that to say, oh goodness, maybe I was missing something. If that's truly an option, that sounds like the option I would use over what I'm doing right now. That's worth looking into because it's a game changer once you understand. Sorry, I just went down.
I love it.
I'm like all over the place.
Man, I'm behind you. I'm behind you all the way. I love that I showed up today with some things in general, thinking about this round table, having conversations with folks, knowing some things that I want to discuss in this format. But I love that I showed up today not knowing that we were going to be talking about buy term and invest the difference and all those aspects there, and then legacy still got to be tied into it in a big way. I love how you recapped it right there, Joe. I'm going to let it be. But man, I'm still saying, to you, and I'm going to air this, I appreciate you being on here. I do have topics, and I have particularly had certain folks that have already been on our round table come to mind for topics. I just want to make sure that they're here when I do bring them out. And I had one this past week that it made me think of you. So I can't wait to address that one in one of these upcoming roundtables. But yeah, man, any other closing thoughts from you today?
No, it's fun, and it was cool. It was like that was all Robin. Robin brought up the buy term invest the difference, and it was just like, I got a bone to pick with that. And off we go. It was fun. I liked it.
Me too. Awesome. What I would encourage everybody to do, though, is your thoughts, your takeaways, your questions about what we have covered, put that down in the comments section below. We will address those. If you've got topics you want to hear fleshed out in this format, put them down and we'll be happy to do that. Otherwise, this has definitely been a great pleasure for me. Joe, Robin, I appreciate y'all being on this conversation with me. You can get in touch with them. Their info will be in the show notes below. You can find me at durhamtalents.com. Live and leave a lasting legacy. Have a great day. Take care.
I'm all for the cause.
And I actually don't mind intentionally putting people in, unexpected, maybe even slightly uncomfortable environments. I love seeing people work through challenges. I just do. I love seeing people try things for the first time, all that kind of stuff. I love it.
I like the organic direction this kind of goes. I like that it's not super scripted. Obviously, you got your secret deck of questions and secret deck of people you're inviting and guests and all. So I don't know what to expect every time I log in.
All right, bud.
Go Birds.